Welcome to this quarter's 20 Minutes on the Market. My name is Josh Whelan. I'm an advisor here at Alterra Advisors, joined by Grant Monson. Grant, thanks for joining.
Hey, great to join you.
So we got a lot to cover. We are recording this actually right between some key events. We're recording this the day after the presidential election and the day before the Federal Reserve is expected to meet to make their next decision on interest rate cuts. So we got a lot to cover. We're going to bring some updates, some focused updates on a few key themes that you have grown accustomed to if you've watched a handful of these. What's happening with inflation? What do we expect to see with interest rates? When are they going to finally start coming down? Well, we've kind of started to answer that question in the last quarter or so. So a lot of people might be asking, will they continue to come down? And then particularly talking about how do markets respond in election years. We're going to cover that. One of the most common questions that we've been getting and talking about with folks over the last couple of months, really. So starting with a look at where the markets have been so far this year, what we're seeing is a lot of positivity, a lot of everything kind of heading in a positive direction. We're used to the theme of things like the S&P 500, which is very tech company, large US dominated. That's really led the charge for a while. The prospects for future growth have been very good, but until interest rates actually started coming down, we hadn't yet seen things like bonds start to recover, even like dividend paying stocks, which this second benchmark here tracks. Now that that has started to happen, even in the last quarter, take a look at the last quarter, you saw the S&P 500 up 5.5%, but you saw dividend stocks rally back. A lot of that is driven by the fact that interest rates are finally starting to come down. When interest rates come down, dividend paying stocks become a more popular source of income. Things that we're thinking about when we look at designing portfolios, particularly for those of you who are retired, are looking to be retired soon, and are shifting from the I'm worried about mostly accumulating and growing my portfolio to now I'm more concerned about protecting what I have. We're seeing positivity across the board here now that interest rates have finally started to come down and trend in that direction. What's important to remember when we look at benchmarks and we talk about benchmarks is that these are signposts. When we look at any of your individual portfolios, what we're doing is we're saying, what is this portfolio supposed to do? What type of companies or strategies is it invested in? And then what are the relative benchmarks that make sense for your portfolio? And using that blend to figure out, are you on track? Do we need to make any adjustments? Is this doing what it should be doing? But really, your plan is always going to drive the strategy forward first. So with that in mind, Grant, why don't you take us through some updates on as we move past kind of what's happening in the market, moving into what's happening in the economy.
Yeah, so let's take a look here and zoom out for a second. So on this slide here, you'll see in front of you here is the general economic speedometers, and we show these each quarter, which are put out that are showing what is the general trend of positive versus negative versus neutral trend over the next kind of looking forward 6 to 9 months in these various areas of the economy. All of these affect and contribute to some of the economic conditions you see right now. And you'll notice there's a couple of red ones on here. I want to highlight those first. One, geopolitical risks. This is probably not a surprise. We have continued war in Ukraine and Russia. We have that instability, I should say, in Israel that continues to thrive. These cause a lot of potentials for various outcomes that are just a risk that needs to be watched. We also see the equity market valuation risk there, or excuse me, I should say negative valuation indicator. And a lot of this is driven by the very full valuation we're seeing on the S&P 500 side of the house or side of the market, if you will, that is inflated by the high valuations of tech and growth stocks. However, there's a lot of areas of opportunity available. That's not a widespread indicator. So it's different for different sectors. Josh was just highlighting dividend stocks for people that are in that place where they want stability and reliable income. Well, those have been much more appropriately or undervalued and are starting to see some movement forward. So depending on your portfolio and what part of it, not all of the equity market valuation is negative. Up at the top left, you'll see monetary policy in the green. With that recent Fed 0.5% rate cut, that's a positive for the economy and moving in the right direction. We're expecting to see another rate cut this week, as in tomorrow, but we'll see. All this is driven by labor market conditions and inflation conditions. And then consumer spending's been strong and is really helping move GDP growth forward. So that is driving profit growth in the corporations and companies and is helping move the charge forward. So we'll see some of the results of that. The most recent real GDP figure was 2.7%, and that was over the trailing year. This is very robust growth in the US economy, and we haven't seen this for a while. So a lot of positive direction there happening.
Yeah, on the real quick on the equity market question, one of the most common questions we've got, particularly from our clients who are concentrated in tech companies right now, maybe you've worked for Microsoft or Amazon or any of these companies for a long time, you've accumulated all this stock and you're growing closer to retirement. One of the key questions we've gotten more recently, especially as those valuations have just continued to climb, is how do I take this? How do I take risk off the table? And how do I convert this into income? So you might be feeling, it's always good to see your portfolio climb, but you might be starting to feel your risk go into that red as well, feeling like I'm so exposed to these companies. What can I do to alleviate some of that risk? So if you're thinking that, you're certainly not alone, and those are questions we're helping people work through a lot right now.
Yeah, absolutely. And if we move on to the big topic of the hour, or I should say the big topic of the last 2 years, inflation. So if we look at the left chart here, you'll see the dark blue line shows the trend line of the consumer price index over time. And it peaked out in June of 2022 at about 9% and has trailed all the way down to 2.4 as of September. This is a good sign. Again, the Fed is targeting 2. So it's not in that, it's not quite there yet, but it has been enough for them to start easing rates, as you've seen, and we expect that to continue. That's a good sign. If we look over to the right side, you'll see the consumer price index, but focusing in on housing or shelter. And this has been a stickier inflated asset. So this has been an area that's been harder to get it down. It's been one of the key areas that the Fed's been focusing on. And one of the things to think about is when you go to a store, you can substitute out kind of what you're purchasing, maybe one expensive good for maybe less expensive good. With housing, you can't really. You can't avoid that. It's a stickier part of inflation, but it has been trending down, which is another reason you're seeing Fed being a little bit more easy on reducing rates or having that kind of mindset. One thing that we want to always remind people of is the Fed's purpose here. Manage unemployment. So they want unemployment, people to be fully employed. That's usually around a 4% unemployment rate, typically targeted. And then they want inflation around 2%. And so those are really the two things they're looking at when you see them come into these meetings periodically through the year. One thing I want to leave you with is remember that when we say inflation's coming down, that doesn't mean that things feel inexpensive when you go to the grocery store.
Right.
What we mean is the rate at which prices at the grocery store are accelerating is coming down. So as for instance, over the last year, they still went up 2.4%. For instance, and we have parts, energy is climbing a lot more right now. We have areas, things are still getting more expensive. It just at a less accelerated rate. So
Mhm.
let's take a talk. Let's look at what does this meant for the stock market and what do we expect to see coming down the road?
Yeah, well, Grant, like you just mentioned, I mean, so we've seen inflation trend in the right direction for quite some time, and the Federal Reserve has said they've been less inclined to start cutting rates as quickly as you might expect. You might be thinking, well, since 2022, if inflation's been plummeting, why haven't we seen rates cut sooner? And they're going, well, there's these sticky parts of the economy that we want to see budge first before we're comfortable starting to cut some of these rates. So in light of the fact that they are starting to see that, which is a positive thing, the next question oftentimes is, okay, when the Federal Reserve starts to cut rates, what happens in the stock market, or historically speaking, at least? There's no way to guarantee what's going to happen, but it can be really helpful to look at history to inform what may happen going forward. And the answer is it depends. If you've watched one of these recently, we've shown this before. This analysis from the economists at City National Rockdale put this together, and it's an interesting analysis because what it says is there's really three reasons why the Federal Reserve tends to cut interest rates. One is to normalize, meaning for a period interest rates were high, now we're cutting to bring them back down to a normal range. Two is because we're sitting in the middle of a recession and it's time to spur growth. And three is in case of an emergency. So where we've been is that rates had been increased to help fight inflation. Well, now that inflation is trending back in the right direction, rates are expected to normalize. That would help us to see we are cutting rates because of a period of normalization. And so what tends to happen in those environments is the market tends to perform positively. The S&P 500 is the benchmark being used here. In the dark blue, you see typical 3 months, typical 6 months, and then typical 12-month response to when rates are starting to be cut to normalize those rates. So there's a lot of reason to think that this could spur the economy on, could help companies grow even faster, and be positive for portfolios. Of course, even if that doesn't happen in this example, this is what tends to happen. Even if that doesn't happen, it doesn't mean that there's massive changes that should take place. What we find is looking historically can help to kind of bracket our expectations and then start to figure out what do I think generally happens when something like this occurs. And so historically speaking, in general, when the Federal Reserve cuts rates to normalize them, it tends to be positive for the stock market. It also tends, by the way, to be positive for the bond market. So here's another analysis that was put together. If you were a retiree in 2022, we wrote multiple articles, multiple resources about this. But retirees, you were some of the folks that got hit the hardest when rates shot up in 2022. Why? Because interest rates going up dramatically in a short-term basis is very unsettling for the stock market. Companies want to be able to predict what they think is going to happen so they can make multi-year plans, grow, invest, and so on. When interest rates are spiking, it makes it really hard for them to do that. So stocks drop because of that. But when interest rates go up, that's also negative for your bonds. And so we had a quarter where bonds, both stocks and bonds were down, but bonds were actually down more than stocks. Historically speaking, that's only happened a couple of times. So if you were a retiree in 2022, you were looking at your portfolio probably going, what in the world is going on? And essentially what happened is there was kind of a perfect storm of events. Now, that said, those of you who looked at this and had good quality discussions about what's happening, why is it happening, what should we do going forward, you've started to recover over the last handful of years, but you've particularly seen some rebound. If interest rates go up and that's negative for your bond prices, the inverse tends to be true as well. So that's what this is showing us here. As rates start to be cut, what tends to happen in different bond markets? So you see a few different benchmarks here, but over 1 year and 3 years, you can see positive results in a lot of different fixed income or bond benchmarks. So it wouldn't be surprising to us to see that side of the portfolio start to rebound. And we've already started to see that. We covered that briefly when we looked at what's happened inside the stock market. Okay, so here's a question that's in our mind then is, okay, it will take positive price changes. That's great. That's always going to be something that is a welcome result of any change. We're also, though, if you're a retiree, we're thinking future income. How do we source income, paychecks that you don't have to worry about? Well, price changes are certainly part of that. Appreciation of your portfolio is certainly part of that. One of the key elements we're thinking about, though, is income from dividends, from interest, the paychecks that show up kind of day in and day out without you having to worry about, oh no, did a stock pop up or down in value today? So as interest rates come down, we are actively looking at things like that and making sure that income can still be sourced appropriately for those of you that are relying on your portfolio for that income. Um, okay, that helps us to kind of see what happens historically speaking when rates are cut. Grant, anything you'd add in there, or does that kind of covers it?
No, I think it covers it. I think the one thing we like to leave people with when they're thinking about, for the folks in the room, they're thinking about getting reliable income regardless of economy and things like that. How do I navigate this? Remember that you own businesses and you're loaning money to businesses for various rates and returns. Just like when you own real estate, you're collecting rent checks. One of the good parts of the market is you can see the value of everything every day. One of the worst parts of the market is you can see the value of everything every day.
Yeah.
And whereas when you own like for those in the room that own like a rental property, which is great, you're not focused on the value of that house every day, but you are focused on that rent check every month. And these bonds or these dividend companies, it's really no different. You're owning an asset, which is a business versus real estate. The problem is the pricing up and down, all the noise that happens can really generate a lot of emotional concern, but a lot of it is in the short term is noise.
Yep, great point. Helping people think about your portfolio like a rental property. If we've had income-oriented discussions, that probably won't be a brand new analogy to you, but
Mhm.
it's what's the quote? Somebody said people need to be reminded more than they need to be taught.
Correct.
That's true
Yep.
for all of us. There's key
All of us.
principles that are driving principles to success, and oftentimes we forget those. And so one of our
Mhm.
key jobs, and believe us or not, the questions we get regularly and repeatedly from clients are the ones that you might be going, "Oh my gosh, I'm so sorry I'm asking you this again, but can you go back over XYZ?" We love those questions. That means we get an opportunity to remind you of something that is likely to lead to your success or prevent significant mistakes that might be
Mhm.
made. So,
Absolutely.
yep, great point. Well, let's cap with a look at how the markets tend to perform around election years. Okay, so this is one of the most common questions. We're recording this the day after the presidential election. Markets are up today. And that's not uncommon, actually. Historically speaking, volatility can pick up after elections, and it it skews toward the positive. Now, why is that? Is it because one party over the other won? No, not at all. It's because the market doesn't like uncertainty. An election is an uncertain outcome. When you turn a question mark into a period, meaning I'm not sure what's going to happen, question mark, I know what happened, period, the market goes, okay, now we know what to do. And so it's not uncommon to see positive response to any sort of an uncertainty made certain, a question mark turned into an answer. Um, but we put this chart up here because what it does is it tracks the market through different blue presidencies and different red presidencies. What do we notice? It tends to go up regardless. Why is that? Well, the market is millions of people and businesses and people looking at the current scenario and trying to make the best that they can out of it. And so when we look historically at the data, there is not a lot of good reason, really much of any good reason, to make significant changes to a long-term investment strategy based on one party winning, the other party winning, the party in power losing or winning, divided Congress even. There's no good consistent trend that says if this happens, you should make a big change because something's either going to change very positively or negatively. What happens in the market? People tend to adapt. And so that's what we see when we look at things historically from a presidential elections perspective.
Yeah, and I think this is a really good time to think about bringing it down a little bit down to Main Street or down to your personal interaction with the world on an
Hmm.
individual level, or if you're a business owner from a business owner level of businesses are trying to create something for a profit and bring it to the consumer base to help create some sort of impact. Individuals are looking for, you as an individual are looking for goods and services of which you can buy that help improve your life, sustain your life, and go forward. When you have changes in results of elections and things like that, the government is really directing what are the rules of which we play in those games and we do our buying and selling within. So they do have impact. We don't want to say they don't have impact. If there's big change in tax reform in 3 years, that will have an impact to the rules of the game of which these individuals like yourself and these businesses play the game, if you will,
That's
but
right.
it
Yep.
doesn't direct the game. That's the
That,
key thing here. So, uh, someone who works at Apple, they got up this morning after the election. They're going to go to work just like they did yesterday, and they think about how do we create the best new version of the iPhone of which consumers are going to love, enjoy, and utilize, and can we do that really, really well within the framework of our economic system we have? And then
yep.
consumers are going to evaluate that and see if that's valid to them and purchase it. So at the end of this, profits drive the value of your companies you own, not partisan.
Yep. Well, and that's it's a perfect kind of segue into some of these themes to remember. History has a lot to teach us. We should start with what history has to teach us. Investment strategy should be driven by your plan. But one of the core things that we bring to the table is what happens when, or what if, what if, what if. We're here to help answer those questions for you as it applies to your plan. We should expect volatility both to the upside and the downside on a short-term basis, but long-term strategies are built with that in mind. And then reach out with concerns. One of the core values that we want to bring to the table is being available to talk through any concern anytime, whether it applies to you or whether it's more hypothetical. But we should be a source of answers, creating clarity, simplicity, certainty in your life. So with that, we'll leave it here for the quarter. Thank you for joining us, and we'll look forward to this again next quarter.